Let's check in with a professional on this whole thing. David Kudla, founder, chief executive officer, and chief investment strategist at Mainstay Capital Management, joins us. David, the market likes what it heard this morning, I guess, anticipating an accommodative Fed going forward. What's your take?
I think that's exactly what we're seeing. Good morning, Paul and Alex. Here's the quandary, right? We have an inverted yield curve for the longest in history, and an inversion very deep that is 8 for 8 on predicting a recession. We have these stats out there: credit card interest rates at an all-time high, delinquencies at an all-time high, auto loan defaults rising rapidly. That is anecdotal data pointing towards problems in the economy. At the same time, we had positive GDP in the fourth quarter, first quarter, and GDP now from the Atlanta Fed is currently above 3% for the second quarter. And that's a very volatile number. Earnings are beat expectations by a wide margin for the first quarter. We're expecting good earnings for the year. We're out of the earnings recession, strong earnings going forward. And the S&P Global PMI has manufacturing and services at 24 and 25-month highs. So there is a lot of conflicting data out there as to where the economy is at right now and where the economy is going. And as far as the Fed, we saw another slight decrease in CPI. And we know, though, that it's going to be, Powell is, we'll see what we hear in the presser today and what kind of guidance we get, what the dot plot shows. But we're seeing inflation being sticky. Even their preferred gauge, services PMI, is at 2.8. They're not at target yet, and inflation is remaining sticky and stubbornly high.
So you think the Fed eventually today takes away that punch bowl by sort of pouring some cold water here?
Well, I think that, and it's become a parlor game, like calling the level of the S&P 500 at the end of the year as to when the Fed will cut. And we see economists and wirehouses with each data point jumping back and forth between July or December or September. But we see the fact of the matter is until it's clear to the FOMC that inflation or CPI is getting close, or PC is getting close to their target, they're not going to cut. They're not going to cut. And there's plenty of economic data they can point to that says the economy is really doing okay, although there's some economic data out there that scares the heck out of me.
So given that backdrop here, how are you thinking about your portfolio construction? What kind of tweaks have you been making maybe over the last several months? What do you anticipate maybe over the next several months?
Well, and that's what we haven't really. We've been on the equity side. We continue to favor large cap over small cap, and we've seen that valuation spread keeps setting multi-year records as well. Large cap over small cap, U.S. over foreign, growth over value. Growth over value being and large over small being very important. Mega cap tech continues to rock and roll. Look at what we've got today. I mean, how many people have come on the show and talked about shorting the mega cap stocks over the past year?
No one.
No one?
No, I haven't heard anyone saying short the mega caps. No way. That's like standing in front of a train.
Oh, well, I agree with you, but we have. I mean, we have. And likewise on the income side, how many people have come on the show and said they're adding duration because the Fed is going to cut rates? They've had their head handed to them. The U.S. aggregate bond index is negative year to date. And what we've been saying is that where you want to be at a 60-40 portfolio, or whatever the income oriented portion of your portfolio is, has to be an ultra short maturity, high yielding with zero duration risk. That produced about a 7.5% return last year with those types of ultra short bond funds, about 3.5% this year. versus a negative U.S. aggregate bond index. So that strategy, that combination of leaning towards large cap growth on our equity side, ultra short, high yielding, zero duration risk in our bond funds, ETFs, bond allocation, it has continued to work very, very well.
And David, you know, you mentioned the U.S. Ag bond index, the Bloomberg index, down 0.9% year to date. But are you surprised that the U.S. corporate high yield is actually up a couple of percent here and has been outperforming really over the last couple of years, given concerns about a recession? Are you surprised that the high yield market's done as well as it has?
Yeah, I mean, credit spreads are tight, and you know, we don't want to be high yield with long duration, right? We're talking about where we're holding high yield, where we're holding bank loan, where we're holding floating rate. I'm talking about an income portfolio or a credit debt portfolio with a duration of about 0.1, not 5 or 6 or 10, right? So we want to, you know, where in each of those categories, we don't want the duration risk. We're not ready for that yet because, look, we think, I said it in my notes, and I'll continue to say it, the first Fed rate cut is months away because they're nowhere near target or they're still far enough away on the target. We had a slight improvement, you know, in this release, but they've got a long way to go unless they change their target to get to 2%.
I know this is sacrilege, like a couple hours before the Fed, but what about ex-US? With the ECB having already cut, but the politics situation there is really upended in France, and also the UK. Anything overseas that strikes your fancy?
Yeah, a good question. You know, when we look abroad, Europe, you know, whether the ECB should be cutting yet or not, they cut a quarter point. In Japan, we've loved Japan for a long time now, with the weakness in the yen, just tremendous for their exporters, other corporate reforms. Japan we've had an allocation to. With all of this, you have to be very careful to hedge the currency because what's happening with the Fed staying tight, ECB cutting, what's happening with the yen, you don't want that, you know, you don't want FX affecting your return. You need the currency hedge in there. But yeah, we're seeing more and more opportunities abroad in that respect. That's why I said our growth over value, our large over small is the important part. U.S. over foreign, I still think it's America first, but there are opportunities abroad, specifically Japan, and I think coming on in Europe now.
All right, David, thank you so much for joining us. David Kudla, founder, chief executive officer, and chief investment officer at Mainstay Capital Management. Appreciate getting a few moments of his time sticking with the large cap growth names, and I guess why not? That's kind of where, you know, we've seen all of the action.